Jim Rutt, the ex-CEO of Network Solutions and chairman of the Santa Fe Institute, recently gave a talk on his experience in business. He said that when he was younger, he used to play a lot of poker, and he got pretty good and started to make some money. And he assumed that if only he could get better at reading the statistics of hands, reading other people's emotions, and hiding his own tells, he would get better and better and make more and more money. But it was at this point that Jim's uncle took him aside and gave him some advice. He said, "Jim, I wouldn't spend my time getting better. I would spend my time finding weaker games. Poker is a zero-sum game. If 6 of us come to the poker table, each with $1,000, we know that there's $6,000 to play for. And if I'm leaving the table with $6,000, it means that the rest of you are leaving with nothing. Now, to win this $6,000, do I need to be the best poker player in the world? No. Do I even need to be any good? No, not necessarily. All I need to be is better than you and the rest of the players at the table." And what Jim's uncle was trying to tell him is that his absolute level of skill was irrelevant. What really mattered was his relative skill compared with the other players. And instead of investing his time getting better at poker, he should spend his time trying to find weaker games. Now, of course, the result of a game is not going to be entirely dependent on skill. There is also going to be an element of luck. But if there's a wide dispersion in skill between the players, where 1 or 2 players are much better than the rest, then luck is going to play a much smaller role. But this is the key thing. As the range of skill in players starts to decrease, so as they start to become more evenly matched, then luck starts to play a much bigger part in the results of the games. And this is true of all zero-sum games, whether that be chess, sport, or even in business. Wherever 2 or more people are pitted against one another, their absolute level of skill is irrelevant. What really matters is their skill compared with each other. It's their relative level of skill that drives results. In tennis, we often like to imagine what would happen if past champions were ever to play each other. Would Federer beat Sampras? Would Djokovic beat Bjorn Borg? Each of them have been champions in their own time. But if these matches were to be played, it's pretty clear that Djokovic and Federer would have a much bigger advantage. And that's because they have access to modern coaching, technology, and nutrition that allows them to push their bodies that much further and allows them to operate at a much higher level of skill. And there's very little doubt that the absolute skill level of tennis players, athletes, and business executives has been increasing over time. But does it mean that it's any easier for them to win a Grand Slam or a business deal? No. In fact, it's harder now than it ever has been before, because now many more people have access to the training, education, and technology that's required to operate at these levels of skill. So the competitions of today are fiercer than they've ever been. And this is the crucial point of this video. If the absolute skill level of players is increasing, but everybody is getting better, and the relative skill of players is decreasing, then luck begins to play a bigger and bigger part in the results. And this concept is known as the paradox of skill. A great example of this comes from baseball. In baseball, batters are judged by their batting averages, which is a simple statistic that tells us how often a player hits the ball when they come in to bat. The key here is that the batting average has nothing to do with the absolute level of skill of the individual players. It's all to do with their relative skill compared with the pitchers and the defense that they're facing. Stephen Jay Gould, the late evolutionary biologist, used the paradox of skill to explain why no one has been able to hit a batting average above 400 since Ted Williams hit 406 in 1941. In his book Triumph and Tragedy in Mudville, Gould showed that over the last 100 years, variances in batting averages had trended down over time, which would suggest that the relative skill of players was becoming more even. Which does make sense. In 1940, baseball was a much less competitive game. You often had players playing multiple positions, and a lot of the time, players weren't even full-time professionals, which means that when you came across specialist star batters that were full-time professionals like Ted Williams, they had the opportunity to bat against teams of much lower levels of skill. Whereas today, baseball has become much more specialized and the relative skill of players is much more evenly matched. And Gould concluded that although the skill of modern players is better than ever. Their relative skill has narrowed. And as we already know, when the relative skill of players becomes more balanced, luck starts to play a much bigger role in the results. Well, we're now already a couple of minutes into the video and you're probably starting to wonder, what has this all got to do with investing and trying to beat the market? Well, if you think about it, trying to beat the market is also a zero-sum game. The market is typically represented by some sort of benchmark or index. And if I was able to go out and generate a return that was above this average without taking any additional risk, then that excess return would be known as alpha. But if I'm able to go out and create alpha and to beat the market, then it must be at the expense of somebody else, who as a result must be getting a lower return and must be trailing the market. And as we saw in poker and baseball, if the relative skill of investors is large, then we would expect skill to play a much larger role in the results. And we would expect that the more skillful investors would be able to go out and create significant alpha at the expense of less skilled investors. But again, just as in baseball and tennis, the relative skill of investors has become narrower over time. And here you can see that since 1967, the average outperformance of the best US mutual funds has slowly been declining. Now, part of this is due to the fact that many active managers are now becoming closet indexers where they just hug their benchmarks. But a significant part of this is due to the paradox of skill. In the 1950s and 60s, professional investors on Wall Street and in the City of London had a massive advantage over their competition. Not only did they have better education and training than most, but they also had access to better technology, tools, and information. In a time when most people read about company news and events in newspapers, simply having a telephone and a list of contacts that can get you information faster gave these professional investors a massive advantage. But since the advent of the internet and the widespread adoption of computers, this advantage has been eroded to where we are today, where we all receive information instantaneously. We can research and learn how to invest on YouTube, and we now have the apps and tools that we need to invest in the palms of our hands. And as a result, the relative skill between the best investors and the average has been declining. Now, you may think this is great because you are smarter or more skillful than the average investor. And I can tell you that if you are watching my channel on YouTube, then you probably are. But unfortunately, we're not competing against the average individual investor. We're competing against the average dollar that's invested and the skill of the people controlling those dollars. In 1950, 93% of US stocks were owned by individual investors and the other 7% were owned by institutions. So in this environment, if you were simply better than the average individual investor, then you would have been in a pretty good position. But as of 2019, retail investors only made up 10% of trading activity. Yes, retail investors do get more active during market extremes, as we've seen over the last year. But for the most part, it's actually just skilled institutional investors battling it out against each other. So the vast majority of money that you're competing against is actually being managed by investors at big institutions. And these investors are much more highly skilled than the average individual investor. So if you want to beat the market, if you want to get a return that's better than average, you're actually going to have to beat those institutional investors. And the problem is that there's a lot of research that shows us that when institutions are pitted against retail investors, institutions come off a lot better. Now, although the relative skill of investors has become more narrow, it's important to note that there still will be some highly skilled individuals that can exploit inefficiencies in the market and can produce high alpha. But just as with modern sports, the competition is so fierce that the chances of becoming one of those investors is harder than it's ever been before. Now, we also need to consider how the rise of index funds affects all this. The standard line is that as index funds grow in popularity, this should create a better environment for active stock pickers, because all this money that's flooding into index funds is being invested in companies without considering their fundamentals, which should, in theory, create inefficiencies and opportunities that active investors can take advantage of. But think about this in the context of the paradox of skill. If more investors are deciding not to play the game and are instead just investing in an index fund and accepting an average return, what does this do for the relative skill of investors? Does it increase it or decrease it? Well, I think it's fair to assume that people choosing to invest in index funds do not rate their own ability at beating the market and would fit within the bottom half of investors in terms of their relative skill. And by removing them from the game, it means that the level of skill of those players left playing the game would increase. And it means that then you just have more skilled active investors just competing against each other. And what you would also see as a result is the level of alpha available decreasing. This is of course just a theory, but it does put an interesting perspective on this debate. So does all this mean that active investing and stock picking is in vain? No, not at all. And again, Jim's uncle's advice can help us explain this. What he said was that if we want to win, we should be looking for weaker games, where the relative skill of players is still wide. And you certainly can find weaker games when it comes to investing. Large cap developed market stocks like Apple and Shell are extremely competitive. Information about these businesses flows freely and millions of people trade them on a daily basis, which means that new information is priced in very quickly. In short, it's getting harder and harder to get a competitive advantage. But when it comes to smaller, less well-known, less traded companies, the competition is much less fierce and the relative skill of investors is much wider, and as a result, it's possible to get an edge. And the same goes for emerging markets, property, and other asset classes where information is less freely available, and the relative skill of investors in that market is more diverse. And just as the paradox of skill would predict, in these less efficient markets, active investors can produce excess returns. They can produce alpha, which is why in my clients' portfolios, I use active fund managers to give exposure to these areas of the market. So what are the takeaways from this video? Just as in sport, the absolute skill of investors is increasing, but the relative skill of investors is decreasing, which means that results are becoming much more dependent on luck. The paradox of skill suggests that index investing actually makes it harder for active managers to beat the market because it removes less skilled participants and reduces the amount of available alpha. As a result, if you want to beat the market, you should focus your attention on markets where the dispersion of skill is still wide, like in smaller companies and emerging markets. This video is largely based on a white paper called Alpha and the Paradox of Skill, which was written by Michael Malboussin and Dan Callahan. For the sake of time, I've had to leave out quite a lot of other really good additional examples, which would have actually added quite a lot more color to this topic. But I've put a link to this article down in the description, and I would highly encourage you to check it out. Just to let you know, my cadence for videos is actually going to be decreasing a little bit over the next couple of weeks, and that's because I'm actually getting married next week, which is great, but it does mean that I'm not going to be able to produce as many videos as I would normally like. But give me a week or two and I will be back at it, producing a video every single week. See you guys.